Welcome to China Legal. Early last month, Deutsche Bank published a report titled China is the World after DeepSeek went viral. The report highlights China's rapid advancement across high-tech sectors and encourages investors to increase exposure to Chinese stocks. Meanwhile, considering China's capital account control, a question is often asked: how to trade Chinese stocks? In fact, China has mapped out a number of viable paths to attract international capital to its stock market. Today, let's walk through them together. Number 1, QFII program. QFII stands for Qualified Foreign Institutional Investor. Introduced in 2002, QFII program allows accredited foreign institutions to invest in China's publicly traded stocks. Applicants must meet specific criteria. The key requirements include sound financial standing, relevant expertise, and robust compliance system. Also, an applicant is required to engage a certified Chinese bank to provide custodian services for planned investments. It's worth noting that before 2020, an applicant must have a minimum assets under management, or AUM. For example, a fund management company or an insurance company should have a minimum AUM of $500 million in the past year. In the case of a securities company, the minimum AUM was $5 billion plus a net assets of $500 million. This AUM threshold is no longer required since 2020. However, in practice, if an applicant meets the previous criterion, it will be easier to obtain QFII license. Number 2, RQFII program. RQFII stands for RMB Qualified Foreign Institutional Investor. RMB is China's currency. Let's call it Chinese yuan instead. RQFII is quite similar to QFII. The major difference is the type of currency. In QFII program, all money should enter and exit China in foreign exchange. On the contrary, in RQFII program, all money should enter and exit China in Chinese yuan. By the way, in September 2019, China removed the investment quotas for both QFII and RQFII programs. That relaxation has greatly enhanced the market's accessibility. Having said that, we still need to pay attention to foreign ownership limits under QFII and RQFII programs. That is, a single QFII or RQFII investor cannot hold more than 10% shares in a single listed company, and all foreign shareholdings in a single listed company cannot exceed 30% of the company's total shares. Number 3, Stock Connect programs. There are 2 Stock Connect programs for the time being. One is the Shanghai-Hong Kong Stock Connect, launched in 2014. The other is the Shenzhen-Hong Kong Stock Connect, launched in 2016. These 2 programs allow offshore investors to trade shares listed on Shanghai and Shenzhen stock exchanges through Hong Kong Stock Exchange, and vice versa. The rules are pretty clear. Offshore investors can trade stocks listed on Shanghai and Shenzhen stock exchanges through Hong Kong brokers. By the way, stocks should be traded in Chinese yuan under both Connect programs, so currency conversion is necessary. Moreover, in each Connect program, there is a daily quota equal to 52 billion Chinese yuan. This daily quota applies to all foreign investments on an aggregated basis for each program. Number 4, Strategic Investment Program. In November 2024, China amended the relevant rules, greatly easing offshore investors' strategic investment in listed companies. Here are some takeaways of the new rules. First, the Ministry of Commerce prior approval is no longer required, and lockup period is reduced to 12 months instead of 36 months in the past. Second, an offshore investor still needs to meet some asset thresholds. Specifically, If an offshore investor would not become the listed company's controlling shareholder, it should have an asset of no less than $15 million or an AUM of no less than $300 million. If the investor would become the listed company's controlling shareholder, it should have an asset of no less than $100 million or an AUM of no less than $500 million. Third, a new investment channel is added. That is, in addition to private placement and negotiated transfer, strategic investment could be made through tender offer. Fourth, new foreign ownership thresholds. Previously, foreign investors' shareholding after closing should reach 10% or more. This threshold is no longer required for private placements. Meanwhile, in negotiated transfers or tender offers, foreign ownership threshold is still required, but reduced to 5%. Fifth, a strategic investment can be carried out by share swap. That is, an offshore investor may exchange an offshore company's shares, including its own shares, for a Chinese listed company's shares. Okay, let's turn to the last viable path for offshore investors to trade Chinese stocks. That is, FDI before IPO. Except in a few highly regulated industries like rare earth mining, securities investment, etc., it's quite easy for an offshore investor to set up or invest in a private company in China. This process of foreign direct investment, or FDI, mainly includes two parts. First, registering with the local company registry. Second, opening a foreign exchange capital account with a Chinese bank for receiving foreign capital. Other regulatory affairs like tax, labor, etc. can be handled by other government agencies through company registry's online platform. This single window approach has made the FDI process much simple and easy in China. After the company goes public in China and lockout periods expires, stocks owned by FDI investors are tradable on Chinese stock exchanges. Notably, although FDI investors can sell stocks they own, they cannot buy any listed company's stocks directly from stock market. Instead, they can only buy stocks through other ways I've just discussed. To sum up, first, QFII, RQFII, and Stock Connect programs are devised for financial or short-term investments. In these programs, offshore investors can buy and sell Chinese stocks and need to comply with the foreign ownership limit, 10% individually and 30% in aggregate. Second, in each Stock Connect program, there is a daily quota of 52 billion Chinese yuan, applicable to all foreign investments. Third, strategic investment and FDI programs are devised for long-term investments. Foreign investors can sell Chinese stocks after lockout periods expire. But if they wish to buy more stocks, they should turn to QFII, RQFII, Stock Connect, or Strategic Investment Program again. Okay, that's all. Thank you for watching. I'm Jason Zhang, a Chinese lawyer and partner from a leading Chinese law firm in Beijing. If you have any legal inquiries, you may send me an email. Here's my email address. See you next time.